Hi, everybody. My name is Sharif Abdu. I am a senior analyst here at Value Line. I'm joined today by another senior analyst, Charlie Moran. So today we're going to provide an update on the economy and the stock market, and then we will recommend one stock to buy right now and answer any questions you may have. Please note that this presentation will be available on our website. That's www.valueline.com. As well as on our YouTube channel within the next 48 hours. All previous webinars are posted there as well. So before we get into the presentation, for those of you joining us for the first time, I want to provide a brief overview of who we are at Value Line. We are a New York headquartered corporation that has been providing investment research for more than 90 years. Our flagship product is the Value Line Investment Survey. This service is a unique source of financial information, and it's designed to help investors make informed investment decisions. And those decisions should fit your individual goals and your individual levels of risk. The product includes data, information, and analysis on equities that trade on the New York Stock Exchange, the NASDAQ, and the Toronto Stock Exchange. Our product also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service is published weekly, and it's created by Value Line's research department, which is comprised of more than 70 analysts, economists, data experts, and quantitative specialists. Our research is completely unbiased. I want to emphasize that we are independent, and unlike many Wall Street brokerage firms, Value Line has no investment banking business with any company. And that includes all the equities that are under our coverage. Value Line does not execute trades for its subscribers. So therefore, we have no vested interest in whether our subscribers buy, sell, or hold a specific equity or security. What's more, our staff of professional securities analysts are not permitted to own any shares of any company that they cover. And if you have any questions about the products or services that we offer, or our different tiers of subscriptions, that information can be found on our website. Again, that's valueline.com, or you can call 1-800-VALUE-LINE. Now, let's discuss the economy and the stock market. This content was created by Value Line's economic staff. So let me just go ahead and read our latest economic view. So I'll open here. The consumer sector remains the main cog in the continued economic expansion, supported by a still tight labor market, which has seen a series of weekly initial unemployment claims declines since mid-June. The U.S. consumer continues to spend, particularly on services. It should be noted that the Conference Board's Consumer Confidence Index, which measures and compares how consumers view the overall economy, business conditions, and labor market presently and over the next 6 months, climbed in July to a 2-year high. The resilience of the U.S. consumer has raised hopes that the Federal Reserve can orchestrate a so-called soft landing for the domestic economy. That said, we have seen some red flags recently, such as lackluster June retail sales data and moderating personal expenditures in May. Then there are concerns that mounting credit card balances financed at higher rates and the resumption of student loan repayments in September will force consumers to cut back on discretionary spending later this year. Earnings season is once again proving to be better than we had feared. True, profits for the S&P 500 companies likely fell for the third consecutive quarter, but comparisons have surprised to the upside. Most importantly, the results from the big bank money centers did not show elevated signs of stress in the financial system. This assuaged worries about a near-term banking crisis. But with interest rates still on the rise, the resultant impact on the health of the overall banking system will be closely scrutinized. A recession down the road is still plausible. The Conference Board's leading economic index, which provides an early indication of significant turning points in the business cycle and where the economy is heading in the near term, has fallen sharply over the last 12 months. Meanwhile, the Treasury market yield curve remains sharply inverted, another significant indicator of tougher economic conditions ahead. In conclusion, the equity market rally, which has been fueled in large part by the strength of the mega cap stocks, has valuations looking stretched. S&P 500 companies recently traded at nearly 20 times earnings, leaving many stocks susceptible to selling on negative news. Thus, we think a well-diversified portfolio of high-quality companies is recommended to reduce possible near-term downside risk associated with a market that's currently trading at a heightened multiple. We ask you to please refer to the inside back cover of our selection and opinion for our statistical-based asset allocation models current reading. Close quote. So that was our economic view, our latest economic view, and it kind of gives you a summary of where Value Line views the current economic conditions and where things may be going in the next, let's say, 6 to 12 months. So on that note, Value Line is providing a great deal of information and analysis to help our subscribers. We know that most of our users depend on our weekly stock reports, our time-tested ranking systems, and other valuable services. In addition, Value Line provides a great deal of daily content that can help you avoid the pitfalls as well as profit during this volatile time in the stock market. Every business day, senior members of Value Line's research department review the most actively traded stocks, company releases, news stories, trade periodicals, and other sources of data and information that may change our view and investment recommendations for specific stocks. When something noteworthy does cross our desk, we publish a supplementary report that outlines the new information and, more importantly, what that information means for our stocks, for our stockholders, and for shareholders in general. This content is posted throughout the day on our website. Again, that's valueline.com. So with that out of the way, I will now show you how to access our website. Once you are signed in, you can head to the dashboard, which is where Charlie is currently residing. This is the main landing page for subscribers. Under the quick links, over on the right-hand side of the page there, you can see the supplementary reports. And Charlie will touch on that and show you what the supplementary reports actually look like when you land on our page. So as you'll see in a moment here, the research department has been busy publishing our updated thoughts on stocks that we track. We strongly suggest that subscribers visit this page often. So I want to just stress on that. Visit this page often. Our time-tested, we're well known for our quarterly reports, the Value Line Investment Survey, but in the intervening time, in that 3 months in between, we publish supplementary reports anytime something new or noteworthy happens with one of the companies under our coverage. And those can be found right here. So some individual companies incurred a lot of debt or sold stock to improve liquidity over the last few years, especially those companies dealing with sharply reduced demand for their offerings, as well as supply chain problems. Due to the changing structure of company balance sheets, Value Line has been reviewing and altering our proprietary financial strength grades for the stocks in our coverage universe. These changes are posted each week in our selection and opinion newsletter. For those of you that don't know, financial strength, along with price stability, which is another proprietary Value Line measure, are the two metrics that are used to calculate a stock's safety rank, which is a key measure of risk. So when you're considering a new stock to invest in, we strongly suggest that you utilize 1, financial strength, and 2, safety in your decision-making process, okay? Financial strength and safety, those are 2 things that you should always look at when you are going through the decision-making process over what stocks or what investments to make. For more information in regard to our proprietary ranks and ratings, Value Line provides a user guide that can be accessed via the investment education section of our website. Lastly, this is a good time to mention that the case for individual stocks is quite strong over broad index funds, let's say. So with that preamble out of the way, let's get into the screener. So this is the screener that we're going to begin now for the one stock to buy right now. For this, you'll see when Charlie gets there in a moment. This is a process that we've actually refined over time. We've refined some of the screening process. We've refined some of the preset screens that we used, etc. This has been refined over time. So Value Line subscribers have access to 15 preset screens and 50 fields. I should also mention that another 100 or so fields are available but that requires a higher level of subscription. If this interests you, please call 1-800-VALUE-LINE. So let's get into the screen itself. Okay, that's enough jibber jabber. Let's get right into it. The economy is seemingly at an inflection point. As I touched on earlier, the Federal Reserve has made some progress in its efforts to tame inflation, but the measure remains above the central bank's target rate. The job market is still tight, though there has been some movement on wages. Interest rates are still elevated, and the possibility of a stateside recession is still looming on the horizon. So with today's candidates, what we really want to emphasize is a good balance between financial stability and upside potential in the intermediate term. So we're not looking, let's say, 3 to 5 years down the road. We're looking at the intermediate term. We're looking at about the next 18 months or so. So we'll start the screening process by looking at financial strength and safety. Okay, and both of those can be found under the ranks and ratings tab. So first we'll start with safety, which Charlie is about to show you right now. And today we want to look at stocks that have a safety rank of 2 or better. Okay, safety rank of 2 or better. There are many risk measures to consider, but today we're going to start with our time-tested safety ranks. Safety measures the total risk of a stock, and it's arranged in an easy-to-understand scale from 1 to 5, with 1 being the most conservative issues. So I want to highlight the fact that stocks that are favorably ranked for safety have in the past held up far better than the broader market during corrections and downturns. They also meaningfully participate in up markets. So for more information about safety as well as our other ranks, I encourage you to peruse our ranking system guide, which is available free of charge from within the investment education section of our website. So by applying that one screen, we've applied a safety rank of 2 or better. We've cut our list of potential candidates down from the entire coverage universe down to 422 candidates. So right now we want to double down on, let's say, stability. So we're going to look at financial strength, which is also under the ranks and ratings tab. So financial strength is already a factor in the calculation for safety, but given the volatility in equity markets of late, we want an additional measure of security. Okay, our financial strength ratings go from C to A++ in 9 increments, with B+ being the midpoint of that range. Today, we're going to focus on companies that garner a financial strength score of A or better. Okay, A or better. So we're looking at better than average financial strength and above. Okay. Now, by applying that additional criteria, we've further reduced our list of candidates down from 422 to 252. Okay. So next, we're going to look at 3 stability metrics. Okay, we're going to look at 3 stability metrics, and they can also be found in the ranks and ratings tab. Those 3 stability metrics are price stability, price growth persistence, and earnings predictability. Those are the 3 additional stability metrics we're going to look at today. Okay. So the first thing we're going to do once Charlie has those up and running. Okay, beautiful. So first one we're going to look at is price stability, and we're going to look at stocks with a price stability of 75 or better. Price stability score of 75 or better. So what we're really emphasizing today, again, is we really want, the economy does seem to be at an inflection point where things can kind of go either way. So we want to kind of have one foot in both camps. If the economy were to flag or maybe have some trouble in the near term, we want something that's going to hold up really well in the case of an economic downturn. But at the same time, we want to benefit even if things turn more favorable. So we want to look at stocks with a price stability score of 75 or better. We're also going to look at a growth persistence score of 75 or better. And the logic is basically the same as the price stability, and the same for earnings predictability. We're going to look at 75 or better. Now, under different conditions, or different economic conditions, and also depending on the individual's, let's say, their risk tolerance, You can go for something with a price stability score that's lower or higher. This is just one possible screening process that we're using today. We're looking at 75 or better. So next, we are going to look at, so we've looked at stability and we've looked at security. So right now we're going to look at performance metrics, okay? We're going to apply our timeliness and technical ranks, which are both also found in the ranks and ratings section. We're going to look at timeliness ranks and technical ranks because we're looking at performance measures right now. Okay, there's our timeliness and there's our technical. So we're going to look at stocks today with a timeliness rank of 3 or better. Timeliness rank of 3 or better. And we can see that by applying that one criteria, we've cut our list down further from 90 down to 72. So let me just touch on what timeliness is for those who don't know. Timeliness is our tried and true measure. It's a proprietary Valand metric that evaluates a stock's projected price performance in the next 6 to 12 months. It's a pretty straightforward scale from 1 to 5, with 1 being the highest. So today we want to focus on stocks that we believe will, at worst, perform in line with the market. Okay? We're going to apply that same logic to the technical rank. So Charlie, we're going to take stocks with a technical rank of 3 or better. And let me just briefly touch on what technical rank is. Whereas timeliness tends to quantify the outlook for the equity in the next 6 to 12 months, technical score is focused on the coming 3 to 6 months. So it's an even shorter time period. So it's 3 to 6 months versus 6 to 12 months. So we're looking at stocks with a technical score of 3 or better. So now we've got our list of candidates down to 60. Okay, we started with the whole Valand coverage universe. We've got it down to 60. So for our final performance measure, we're going to look at our 18-month TPR midpoint. Okay, and that can be found under the company data tab near the top of the page. For those who are not familiar, I mean, we're very well known for our timeliness ranks, obviously, which again measures which we're attempting to quantify a company's their prospects in the coming 6 to 12 months. But over the last few years, we've also instituted our 18-month TPR midpoint. And this is something that gives us a window into the intermediate term. So we're extending our investment horizon a little bit. Now we're going from 6 to 12 months to 18 months. And today, we're going to look at stocks with an 18-month appreciation potential of 20% or better. So let's go ahead and apply that screen. We're going to look at stocks with an appreciation of 20% or better. And voila, we've cut our list down to our final 17 candidates. I think that's a pretty good list. We could apply another screening criteria, but I think 17 is a good number. Now, you can make a strong argument for any of our remaining candidates, and investors that are interested in adding new positions should consider them. However, only one can be today's one stock to buy right now, and after consulting with a number of our senior analysts, we prefer and recommend MasterCard, ticker symbol MA. So before Charlie clicks on MasterCard, before we get a little bit more in depth on that one, I should mention that you can save and revisit the screen that we just used today by applying by clicking on the Create Save Screen button at the top right of the page. Okay. Now, let's go ahead and jump right into MasterCard. First, we're going to take a look at our last full-page report. This report was actually published in May. We actually just went to press with our next report on MasterCard. I can't say too much about that content since it won't be accessible to our subscribers for a few more days, but I can lightly touch on our updated estimates and also briefly go through the company's second quarter results, which were just released today. So the company just released their second quarter earnings results today. So that's kind of fortuitous, right? We're touching on the company today and they just released results. And spoilers, the results were actually pretty decent. They were a little bit better than what we had expected, so that's a good thing. So as you can see in the middle of the page, that is our statistical array. MasterCard's revenues and earnings per share advanced 18% and 27% in 2022. So the results were obviously very good. In 2022, that was driven by higher transaction activity around the world, with its overseas operations actually outpacing growth in North America. That's a trend that we've seen with MasterCard over the last couple of years. That trend actually continued through the first 6 months of 2023, and we expect that to be the case probably for the remainder of this year and maybe a little bit beyond that. So I'm going to briefly touch on what MasterCard did in the second quarter. They just released their second quarter earnings results, and I'm going to briefly touch on that. Revenues and earnings both topped our estimates. They expanded 14% and 13%, respectively, to $6.3 billion and $2.89 per share. Excuse me. Transaction data remained solid, with gross dollar volume up 10% worldwide. Europe and Latin America continued to lead the charge. Europe transaction data was up 21%. In Latin America, it was up 18%. So that's pretty good, obviously. We expect revenues and earnings per share to make solid progress in the next 2 years and well beyond that. So some of the progress we foresee for MasterCard in the next couple of years will depend on the state of the global economy. However, we feel there's good downside protection here. That's why we really like MasterCard. With the exception of 2020, which was obviously the year that was ravaged by the COVID-19 pandemic, MasterCard's revenues and earnings per share have advanced every year since the company went public in 2006. So they haven't skipped a beat. MasterCard has built a resilient business model with solid operating results, both in good economic times and bad. And now if we take a look at some of the quantitative metrics for MasterCard, we see that the stock has solid marks across the board. That includes a safety mark of 1, which is our highest. Charlie, if you want to scroll up to the top left of the page there, we see that it has a safety rank of 1 and a financial strength rating of A++. That's at the bottom right of the page. And as we can see in that same box there with the financial strength, so it's an A++, again, our highest rating. It also has good scores for price stability, price growth persistence, and earnings predictability. So it's just a really good, sound company. Upside potential, interestingly enough, is actually pretty good in the next 18 months. It's above average at 20%. The current value line median for the next 18 months is, I think, about 12 to 13%. So MasterCard's a little bit better than average. We think MasterCard is poised for strong results in the next 2 years and beyond, and we think the stock can form one of the building blocks of a well-diversified portfolio. It's today's one stock to buy right now, and we will now tackle your questions. Please note that we typically can't answer complex questions about specific stocks on the spot. For this, I would recommend a review of our latest report. Now we're going to touch on some of your questions. The first few were submitted prior to this presentation. Charlie, is there anything jumping out at you? I'll let you take the first question. Okay, I see a question here. A subscriber asked about cash flow. Actually, specifically asking about what is the distinction between cash flow and free cash flow. So if you look at the page for MasterCard right now, which Charlie has up on the screen, we see that in 2022, MasterCard had a cash flow per share of $11.17. Now, I'll touch on how Value Line calculates cash flow. Cash flow is pretty simple calculation. It's just net income, the total net income for the company, plus non-cash charges. The most typical non-cash charge is depreciation. So it's going to be net income plus depreciation, and that's divided by the number of shares outstanding. Pretty simple, pretty straightforward. Cash flow is one of those measures that's analysts like it because it's very easy to follow. It's not too subjective, but it's pretty easy to follow. Pretty simple calculation. Now, the distinction with free cash flow is that free cash flow, it encompasses a little bit more beyond net income and depreciation. It's the company that the company has left over after paying its operating expenses and capital expenditures. So what does that mean? So for an example, a capital expenditure would be the company building a new manufacturing plant. It would be the company, if it's a real estate company, they're making an acquisition. If it's a company like, let's say it's a supermarket or a grocery store, they're enhancing their store base. They're making investments in technology. They're investing in their supply chain. That would be an example of capital expenditures. So free cash flow is the company that the company has left over after paying its operating expenses and its capital expenditures. So the second part of that question that the subscriber submitted is, what is cash flow yield? So cash flow yield is actually not something that we touch on much in our reports. I don't think we really ever mention it, to be honest. Cash flow yield, it's a measure of how it's free cash flow relative to the company's market capitalization. Okay, so you would look at what the gross free cash flow number is, and you would divide it by the market cap of the company, and that would give you the cash flow yield. I'm trying to think of an easy way to kind of explain it. It's kind of like shorthand for all the cash that the company is paying out to its stakeholders. Okay, think of it that way. It's all the cash the company is paying out to its stakeholders through dividends and through interest. So that is what the free cash flow yield is meant to tell you. Okay, Charlie, is there anything jumping out at you? Any other questions?
There was one other regarding, from Mary, she had mentioned what defense stocks should be bought now, and I just wanted to state that we don't have an opinion on specific industries. However, we do have an industry rank that many people use as kind of a screen itself to look at the best industries that we rank, and then go from there and look at the specifics within those highly ranked industries. You can see that industry rank right beneath the stock. We go back, I hope this is visible right here. The MasterCard page has the financial service rank is 51 out of 93. So it's in the middle. Her specific question was regarding defense stocks. Now, if you were to look at the industry rank and then go from there to the individual reports, you can select individual ranks that are consistent with your portfolio objectives, but also if you have a theme, in your case, looking at defense, you may have wondered about stocks that are involved in certain programs. You can get a better sense as to which names are leveraged to those programs. But I just wanted to highlight the industry rank as something that's often not discussed, and that is ranked like the timeliness ranked out of the 93 industries that we cover. Anything else, Sharif?
Let me see. Let's see. Where can I find a description of timeliness, safety, and technical ranks? Charlie, if you want to show them the investment education section, there's an entire glossary there. So we go under investment education. And you'll see that there's a
which one?
There's a glossary. The glossary, where the very last one, yeah, glossary. Yeah. So you'll see that all the terms, all the terminology that we use in our reports and our presentations, it's all explained here. That includes timeliness ranks, technical ranks, safety ranks, financial strength, earnings predictability, beta coefficient, yada, yada. Everything is explained and defined here. This is actually a very good resource. Highly recommend that you visit it. If you ever have a question, this is a good starting point. Let's see. Anything else jumping out? Anything else jumping out?
Not on my end.
Yeah, I don't see anything else that's jumping out at me. Okay, Charlie, I think with that in mind, we're going to go ahead and wrap things up for today. If anybody has any questions, please feel free to visit our website. That's valueline.com. You can also call. That is 1-800-VALUE-LINE. With that, I'm going to hand it over to Earl. Thank you for everybody for coming along with us today.
Thank you for joining today's session. You may now disconnect your lines and have a great day.